The only smart money concepts, SMC. You'll ever need smart money concepts is one of the most searched trading methodologies on the internet right now. Traders at every level, from complete beginners to people who've been in the markets for years, are studying order blocks, fair value gaps, breaker blocks, liquidity sweeps, market structure shifts, displacement, imbalances, and on and on. The content is everywhere. The terminology is everywhere. And yet, the number one complaint you hear from traders who've spent months studying SMC is this: I understand the individual concepts, but I still don't know how to actually trade. That is not a coincidence, and it is not your fault. The problem is almost never the trader's intelligence or effort. The problem is how SMC gets taught. Most of what's out there presents these concepts as a menu, a list of tools you're supposed to eventually memorize and somehow combine on the fly. You learn what an order block looks like. You learn what a fair value gap looks like. You learn what a liquidity sweep looks like. But nobody ever shows you why one leads to the other, in what sequence they operate, and what has to be true on your chart before any individual concept even becomes relevant. So you end up with a head full of labels and no mechanical framework to apply them. That's the paralysis most SMC traders are sitting in right now. Look at the screen right now. This video is going to fix that, not by adding more concepts, by doing the opposite. What I'm going to do in this video is strip SMC down to its absolute mechanical core. We are going to cut everything that is supplementary, everything that overlaps, and everything that only makes sense after you already know how the system works. And we are going to focus exclusively on the concepts that directly cause price to move in the exact sequence they operate. You are going to walk away from this video with a cause and effect framework, not a vocabulary list. Here's exactly how this video is structured. There are 6 steps, and each one builds directly on the one before it. Step 1 is market structure, the foundation that every other SMC concept depends on. Step 2 is liquidity, specifically where smart money is actually targeting and why. Step 3 is order blocks, the engine behind the move itself. Step 4 is fair value gaps, how you time entries with mechanical precision. Step 5 is putting it all together into a single, coherent SMC trade sequence. And step 6 is the filters, what separates a high probability setup from a trap that looks identical on the surface. I'm going to show you exactly what I mean as we go through each one, with real chart mechanics, not theory. Now, here is the one thing I need you to understand before we get into step 1. This is a system. Each step in this video is incomplete without the next one. If you skip ahead or drop off early, you will take one piece of a 6-piece framework and try to trade with it. And that is precisely the problem we are trying to solve. Stay through all 6 steps. That is the only way this works. Keep your eyes on this chart because we are starting with step 1 right now. And before any order block, any fair value gap, any liquidity level makes a single bit of sense, there is one thing the market is always doing. It has been doing it on every time frame, in every instrument, across every session. And once you see exactly what that one thing is, you will never look at a chart the same way again. Market structure is not a concept you interpret. It is not something you eyeball and make a judgment call on. It is a mechanical sequence, and either price is printing that sequence or it isn't. There's no gray area here, and the moment you treat it like there is, every other SMC concept you try to apply becomes guesswork. Here's the sequence. In a bullish structure, price prints a higher high, then pulls back and holds a higher low, then pushes up to print another higher high. That pattern, HHHL, HHHL, is bullish structure, not because it looks like an uptrend, because the mechanical definition of bullish structure is that exact sequence of highs and lows. The cause is that price is making higher pivot points. The effect is that you have a confirmed bullish structure, full stop. Bearish structure is the mirror. Lower low, then a rally that fails to break the previous high, printing a lower high, then a new lower low. LL, LH, LL, LH. That sequence means bearish structure, mechanically, not visually. Look at this chart right here. Every time you see a swing high followed by a swing low that is higher than the previous swing low, that is bullish structure being built in real time. Price is doing one thing and one thing only. It is telling you the sequence. Your only job at this stage is to read it without adding opinion. Now, within that basic definition, there is a distinction that most traders skip entirely, and skipping it is why their analysis constantly conflicts with what price actually does. There are 2 layers of structure on any chart, internal structure and external structure. External structure is your dominant directional bias. These are the major swing highs and swing lows, the ones that define the overall direction the market is moving in. If you zoom out on a daily chart and price has been printing a clear sequence of higher highs and higher lows over the last several weeks, that is your external structure. That is the story the market is telling at the macro level. Internal structure is everything happening inside those major swings, the smaller pushes, the minor pivot points, the short-term sequences forming within the larger move. And here's why this distinction is mechanically important. Internal structure tells you what smart money is doing right now. Are they accumulating? Are they distributing? Are they engineering a short-term move? External structure tells you the direction they are building toward. Those are two different questions, and they require two different structural reads. On screen, you can see exactly what I'm describing. Inside a single bullish leg on the daily chart, the lower time frame internal structure might be showing a short sequence of lower highs and lower lows. A temporary bearish internal move. That is not a reversal. That is the internal retracement happening inside the bullish external structure. If you're only watching the lower time frame, you see what looks like a bearish trend. If you're reading both layers, you understand it's a pullback. Now let's talk about the two most important structural events, and the one distinction most SMC traders get wrong. A break of structure, or BOS, is what happens when price takes out the previous swing point in the direction of the existing trend. In a bullish structure, a BOS is when price pushes above the most recent confirmed swing high. Cause: price broke the previous high. Effect: the bullish structure is confirmed to be continuing. That's it. A BOS is continuation evidence. It means the trend is doing exactly what a trend does. A change of character, or CHoCH, is a completely different event. A CHoCH occurs when price breaks the opposite side of structure for the first time. In a bullish structure, that means price breaks below the most recent higher low, the last confirmed low that was supposed to hold. Cause: price violated the structural low that defines the uptrend. Effect: there is now evidence of intent to reverse, not a confirmed reversal, evidence. That word matters. A CHoCH is not a signal to immediately flip your bias and enter in the opposite direction. It is the market's first indication that the structure may be shifting. It is the warning. The confirmation comes from what price does after the CHoCH, whether it follows through with new structural lows or whether it recovers and resumes. Look at this chart right here. See where price is in a clear bullish sequence. HH, HL, HH, and then watch what happens when it breaks that last HL. That break is the CHoCH. Now watch what price does next. The CHoCH opened the question. The subsequent price action answers it. If you entered a short the moment CHoCH printed without waiting for follow through, you're trading a signal before the market has confirmed anything. The traders who confuse BOS and CHoCH are the ones who call tops and bottoms prematurely, constantly. They see a swing low break and immediately think reversal, but if that swing low was an internal low inside a bullish external structure, that break is not a CHoCH on the level that matters. It is noise inside a trend. This is where the hierarchy of time frames becomes non-negotiable. Top-down analysis is not a style preference. It is a mechanical filter. Here's how it works. The higher time frame structure defines your bias. The lower time frame structure defines your entry timing. Those are two different functions, and they do not swap roles. If the daily chart shows bearish external structure, lower highs, lower lows, and a confirmed CHoCH from the prior bullish run, then your bias is bearish. That means every bullish move you see on the 15-minute chart is a retracement within the bearish bias. It is not a new uptrend. It does not override the daily structure. The 15-minute is showing you the internal mechanics of a pullback and nothing more. Pause here and study this structure before we move on. On screen, you have a daily chart showing a clear bearish CHoCH and the beginning of a new lower high forming. Below it, on the 15-minute, price is pushing up. It looks bullish. If you only had the 15-minute open, you'd see an uptrend. With the daily context, you see a retracement. These two reads of the same price action are not both valid at the same time. The higher time frame wins, mechanically, always. This is the most common structural mistake in SMC trading, and it is responsible for more bad entries than any other single error. A trader marks structure on the 5-minute, they see a CHoCH on the 5-minute, they enter a short, they get stopped out. What they didn't check is that the 4-hour is in a clear bullish structure, and that 5-minute CHoCH is occurring right at a 4-hour higher low. The structure on the 5-minute was never the relevant structure. It was a sub-move inside a larger bullish leg. The time frame that matters is the one where the dominant structural bias lives. And that is always the higher time frame. The practical rule is this: before you mark any structure on a lower time frame, you must know what the higher time frame structure is doing. The HTF gives you the direction. The LTF gives you the precise moment to act. If those two are aligned, you have mechanical confluence. If they conflict, the LTF setup is invalid until the HTF structure changes, because you'd be trading against the dominant flow and simply not know it. Keep your eyes on this chart. This is what aligned structure looks like. Daily is bearish, 4 hour is printing a lower high, 15-minute is showing a BOS to the downside inside that lower high formation. Every layer is saying the same thing. That alignment is not optional. It is the baseline requirement before any other SMC concept gets applied. Now here's where this step ends, and where it immediately becomes incomplete. You now know how to read where the market is going. You can identify the structural sequence. You know the difference between BOS and CHoCH. You understand how to layer timeframes to get a directional bias. That is the foundation. But here's the question this step doesn't answer. Why does price move in this sequence at all? Why does it push to a specific high, pull back to a specific low, and then accelerate again? Structure describes the pattern. It does not explain the mechanism behind the pattern. And the mechanism, the actual reason price moves where it moves, is something most retail traders have completely backwards. They think price moves toward value, toward fair areas, toward balanced supply and demand. It doesn't. Price moves toward liquidity. And once you understand what liquidity actually is, where it sits on your chart, and why smart money needs it, every structural move you just learned to read will suddenly have a reason behind it. Now that you can read market structure, you know the direction price is moving, but here's what structure alone doesn't tell you. Price almost never moves in a straight line from point A to point B. It detours, it spikes, it briefly goes the wrong way before it goes the right way, and most traders look at those detours and see randomness or manipulation. What you're actually looking at is price doing exactly what it needs to do, collecting liquidity. Liquidity, in mechanical terms, is a cluster of pending orders sitting in the market waiting to be triggered. These aren't abstract pools of capital. They are physical stop-loss orders placed by retail traders at specific predictable locations. And the reason they're predictable is simple. Retail traders follow the same rules. Place your stop above the swing high. Place your stop below the swing low. Set it just past the round number. Protect yourself at the trend line. Every trader following those rules, and millions of them is depositing their stop order into the same location. That location is now a liquidity pool. Smart money in the large institutional participants moving the kind of size that actually shifts price has a problem that retail traders don't. They cannot fill a position of that scale without finding orders on the other side. If you need to buy 50,000 contracts, you need 50,000 contracts worth of sellers. Those sellers don't appear out of thin air. They appear when price moves to where the sell orders are already waiting, which is exactly where retail traders place their stops. So smart money doesn't just stumble into liquidity, they engineer price to reach it. Look at these equal highs on screen. That is your first and most important liquidity location to understand. Equal highs, or EQH, form when price tests the same swing high level twice without breaking through it. To the retail trader, that looks like a double top, a reversal pattern. Here's what's mechanically happening at that second touch. Every trader who went short at the first high placed a stop loss just above it. Every trader who watched price fail at that level and said strong resistance also placed a stop above it. The result is a dense cluster of buy stops stacked directly above that level. That cluster is a magnet. Price doesn't test that level a second time because of supply. It tests it because there are orders there that need to be collected. When price finally pushes through that level and triggers those stops, those buy orders fill the institutional seller's position. That's the mechanism. Equal lows work identically in reverse. Two touches of the same swing low means a cluster of sell stops sitting just beneath it. Every long position that placed a stop below support is sitting in that pool. Price will sweep below, trigger those orders, fill institutional buy positions, and reverse. On this chart I'm showing you right now, study these wick tails beneath a double bottom. That wick is the sweep. That is not a failed breakdown. That is price mechanically reaching the liquidity it needed. The second major liquidity location is previous session highs and lows. The Asian session is the clearest example. During the Asian session, price typically consolidates in a relatively tight range. What's accumulating on both sides of that range are resting orders, breakout traders waiting for a move above the high, and breakout traders waiting for a move below the low. Both sides are loaded. When the London session opens, one of the most consistent mechanical behaviors in the market is a sweep of the Asian high or low. Not because London breaks out, because London goes to collect the orders sitting at that boundary before the real directional move begins. Same logic applies to the previous day high and low. Those levels represent the extreme boundaries of the prior session's accepted price range. Retail breakout systems and range traders place orders at those boundaries routinely. The result, two predictable liquidity pools, one above and one below, refreshed every single day. Freeze this frame and study where those stops are sitting. Above the prior day high, buy stops. Below the prior day low, sell stops. Price will frequently visit one of those levels before committing to direction. That visit is not indecision, it is collection. Round numbers and trendline clusters are secondary liquidity pools, but they operate on the same principle. Round numbers, whole numbers, 0-0 levels, 0-0-0 levels, attract stop placement because traders psychologically anchor to them. Trendlines attract stops because every trader drawing the same trend line is placing a stop just beyond the touch point. The mechanical result is identical, concentrated orders at predictable coordinates. Now let's talk about what actually happens when price reaches one of these pools, because this is where most traders misread the event entirely. A liquidity sweep follows a specific mechanical sequence. Price approaches the pool, price breaches the level, triggering the stops. Then price rejects sharply and moves in the opposite direction. Retail traders look at that sequence and call it a fake breakout. That label is technically accurate but mechanically useless. A fake breakout tells you what didn't happen. A liquidity sweep tells you why it happened and what comes next. Here's the mechanical reality. Your stop loss was the institutional entry. When your long position's stop got triggered below that equal low, the sell order that filled your stop was the buy order that filled an institutional position. The reversal you watched happen after your stop was hit. That reversal was funded by your exit. The institution needed your order to get long. Your stop was the liquidity they were targeting. On screen, you can see exactly what this looks like in real time. Price drops below the equal lows. That's the sweep. There's a sharp wick below the level. Then price closes back above the swept level on the next candle or within the same candle. That close back above is your mechanical confirmation. The sweep happened. The orders were collected. The condition for a reversal now exists. And that word, condition, is critical because this is where the common mistake lives. A sweep creates the condition for a reversal. It does not confirm one. The mechanical error traders make constantly is entering the moment they see the wick. Price swept below support. They see the candle wicking back. They enter long immediately. The confirmation they skipped is the strong close back above the swept level, ideally on a meaningful time frame, not a 1-minute candle. Without that close, you have a wick into liquidity that could just as easily continue lower. Sweeps that continue lower are not unusual. They happen when the institutional order at that level wasn't sufficient to reverse the flow, and price proceeds to the next liquidity pool deeper in the range. If you enter on the wick without the close confirmation, you're in a position with no mechanical basis for entry, and you'll watch price sweep through you to the next level down. Look at this chart right here. Two sweeps side by side. One that reverses, one that continues. The difference is the candle close. The reversal sweep has a strong close back above the level within a candle or two. The continuation sweep has a weak close that doesn't reclaim the level. That close is the filter. Without it, a sweep is just a touch. Now let's connect this back to structure, because liquidity and structure aren't separate tools. They're two parts of the same mechanical chain. Structure tells you the direction. Liquidity tells you the destination price needs to visit before it continues in that direction. In a bullish structure, the most recent higher low is being protected by buy stops sitting just below it. Every long trader who entered at that HL placed a stop beneath it. That cluster of stops is resting liquidity, and price will frequently sweep below that HL before it launches the next leg higher. When you see that sweep happen, the retail trader panics because their stop got hit and structure looks broken. Mechanically, what just happened is that price collected the fuel it needed to push higher. The bullish structure isn't violated, it was just serviced. This is the practical rule. In a trending structure, expect price to revisit liquidity at the last structural low before continuing. That sweep is part of the move, not a sign the move is over. When you understand that, you stop getting shaken out of good trades and you start seeing those sweeps as entry opportunities rather than exits. Pause here before we go to step 3. You now have 2 layers of the framework. Structure gives you the direction, liquidity gives you the destination, the specific price coordinates where smart money needs to go before it can move. But there's still a question this step doesn't fully answer. Where exactly did smart money enter their position? You know they collected liquidity at the sweep, but the entry that caused the reversal didn't come from nowhere. It came from a specific price zone where an institutional order was sitting, waiting to be filled. That zone has a name, and it's not just where smart money entered, it's the level price will return to, often multiple times because the position was too large to fill in one shot. You now know the direction price is moving, and you know the liquidity pools it needs to visit before it gets there. What you don't know yet is where the position was built that caused the move in the first place, because every impulsive move on your chart, every sharp decisive leg that broke structure or swept a liquidity pool, originated from a specific price zone where institutional orders were placed. That zone didn't disappear when price left it, it's still there. And when price comes back to it, those orders are still waiting. That zone is called an order block. An order block, in mechanical terms, is the last opposing candle before a significant impulsive move. Let's unpack that precisely. If you have a strong bullish impulse, a sharp move up that broke a swing high, look at the candle directly before that impulse began. In most cases, that candle is bearish. It's red, and that seems wrong at first. Why would the zone that caused a bullish explosion be a bearish candle? Here's the mechanical answer. Because that bearish candle is exactly where institutional buy orders were placed. Large buy orders require a down close candle to fill. The institution is buying while retail sees a bearish candle and expects lower prices. The moment that institutional buy order is fully placed, price has no more reason to go down, and it explodes upward. So a bullish order block is a bearish candle. You're the last bearish candle in a cluster, immediately before a strong bullish impulse. The bearish OB is the mirror, a bullish candle immediately before a strong bearish impulse. In both cases, the logic is the same. The opposing candle is where the position was built. The impulse is what happens the moment that position is complete. On the chart, you can see this exact candle right now, that red candle sitting at the base of a bullish explosion. That is the bullish order block. That is not where retail was selling. That is where the institution was buying. The retail sell orders provided the liquidity for the institutional buy to fill. Now price has moved away, and that red candle marks the zone where a portion of that institutional position is still resting. Now let's talk about what makes an order block valid, because not every opposing candle before any move qualifies. There are 3 criteria, and all 3 need to be present. Miss one and the zone you're marking is not a real OB, it's noise. Criterion 1, the impulse that follows the OB must be strong and sharp, not a gradual drift in the new direction, a clear, decisive move. The reason this matters mechanically is proportionality. The strength of the departure from a zone is directly proportional to the size of the institutional order placed inside it. A weak, slow move away from a candle means a small, insignificant order. That's not an institutional footprint. A strong, fast impulse means a large order was placed. That's what you're looking for. If the move away from the candle doesn't stand out visually on your chart, the order inside that candle wasn't significant enough to act as support or resistance when price returns. Look at this impulse here. That is the qualifying move. Look at how fast price leaves the zone. Look at how many candles it covers in a short time. That displacement is the evidence that something large was placed in the candle before it. Criterion 2, the move that originates from the OB must have caused a break of structure or a change of character. This is the structural filter, and it's the most important criterion for separating real OBs from random candles. Cause and effect. If a genuine institutional order is placed at scale inside that candle, the resulting impulse will be strong enough to break a structural level. That's what institutional size does. It moves the market. If the move from your potential OB didn't break any structural point, the order inside it wasn't large enough to matter. The OB is structurally unconfirmed. You don't mark it. This criterion alone eliminates the majority of false OBs that clutter most traders' charts. Criterion 3, the OB must not have been mitigated. Mitigation means price has already returned to the zone and traded completely through it. When price revisits an OB, the remaining portion of the institutional order at that level gets filled. Once the order is fully filled, there's nothing left in that zone to cause a reaction. The zone is neutralized. A mitigated OB is a dead zone. Marking it and expecting a reaction from it is expecting a response from an order that no longer exists. I'm highlighting the OB right now so you can see exactly what we're talking about. This first touch of the zone, price comes in, reacts, and moves away. The OB is still active, the order was partially filled but not fully consumed. Now look at this second touch. Price comes in, pushes through the zone completely, and continues past it without reversing. That is mitigation. That zone is done. Don't mark it again. Don't trade it again. Now let's address the most common way traders misapply order blocks, because it's a structural error that turns a powerful tool into a chart covered in useless zones. The wrong way is this. A trader learns what an OB looks like and starts marking every opposing candle before every move on the chart. The result is a chart with 30 zones on it, spanning multiple time frames, with no filter for which ones are relevant. Every retrace to any zone becomes a potential entry. The trader takes 5 setups in a session, 4 of them fail, and they conclude that order blocks don't work. The problem isn't the concept. The problem is that without the 2 criteria, no strong impulse and structural significance, the trader is not marking order blocks. They're marking random candles and hoping. The right way is strict. You only mark an OB if the impulse that followed it created a BOS or a CHoCH on a time frame aligned with your higher time frame bias. That filter means that on any given chart, there are very few valid OBs at any one time. That is correct. Fewer zones, higher quality reactions. The scarcity is not a problem, it is the point. On this chart right here, you can see the difference. On the left, every opposing candle is marked. The chart is unreadable. On the right, only the candles preceding structural breaks are marked. 3 clean zones on the entire chart. Those 3 zones are the ones price will respect. The other 20 were noise. Now, even once you've identified a valid OB, there's one more step before you can use it for precise entries: refinement. A raw order block marked on the time frame you're analyzing will often span several candles and a meaningful price range. That range represents your entry zone, but it's imprecise. The actual origin of the institutional order is inside that range, and drilling into a lower time frame to find it gives you a much tighter entry. Here's the mechanical consequence of refinement. A tighter entry means a tighter stop. A tighter stop on the same target means a better risk to reward ratio. This is not a stylistic preference. It is a direct mathematical consequence of using a more precise entry zone. If a raw OB gives you a 30 pip stop and your target is 60 pips, your R is 2.1. If refinement gets your stop to 15 pips on the same target, your R is 4.1. Same trade, same target, better ratio, purely because of precision. Pause here and study this OB on screen. The raw zone on the 1 hour is marked in full. Now watch what happens when we drill into the 15-minute. The actual origin candle is the last bearish candle inside that zone, and it's half the size of the full zone. That is your refined OB. That is your entry range. Now let's build the full sequence we have so far, because this is where the framework starts to become a complete chain. Higher time frame structure defines your bias. Price sweeps a liquidity pool in the direction opposite to that bias, collecting the orders it needed. Then price returns to the order block that caused the last structural break. At that OB, the remaining institutional order is still present. Price reacts from it and continues in the direction of the HTF bias. Your entry is at the OB, your stop is just beyond it, and your target is the next liquidity pool on the higher time frame. That is the chain. Structure, liquidity, order block. 3 steps, 1 mechanical sequence. Look at this chart right now. Every component of that chain is visible. HTF bearish bias. Liquidity sweep above the last lower high. Price returns to the bearish OB that caused the CHoCH. Reaction at the OB. Continuation downward toward the next pool of sell-side liquidity below the range. But here's the problem. This step leaves unsolved, and it's a real one. Price returning to an order block does not automatically mean it will react immediately. Price can enter the OB zone, hover inside it for multiple candles, push deeper into it before reversing, or give you an entry signal on 1 candle that fails and then gives the real entry 2 candles later. The OB tells you where smart money's orders are. It does not tell you the exact moment those orders are activating. That precision of the specific moment inside the OB zone where the entry is confirmed comes from one thing: the fair value gap, and most traders who know about fair value gaps are using them completely wrong, which means they're entering too early, too late, or at the wrong level entirely. Step 4 fixes that. You have the bias from structure. You have the destination from liquidity. You have the entry zone from the order block. The remaining problem is this. An order block is a zone, not a price. It can span 20, 30, sometimes 50 pips of price range. Entering at the top of that zone, the middle or the bottom, produces completely different risk to reward ratios and completely different outcomes. Price can enter the OB zone and hover for 5 candles before it reacts. It can push past the top half of the zone and only react at the bottom half. Without a precision tool inside the OB, your entry is still an approximation. Fair value gaps solve that. A fair value gap is a 3-candle structure. Here's the mechanical definition. Candle 1 closes at a certain level. Candle 2, the middle candle, moves so aggressively in one direction that when candle 3 forms, its wick doesn't overlap with candle 1's wick. That gap between the high of candle 1 and the low of candle 3 is the fair value gap. That is a range of price that was never properly traded. Price blew through it so fast that buy orders and sell orders never met inside that zone. In a bullish FVG, the impulse is upward. The gap sits between the high of candle 1 and the low of candle 3, and it's a zone price skipped over on the way up. In a bearish FVG, the impulse is downward. The gap sits between the low of candle 1 and the high of candle 3. A zone price skipped over on the way down. The structure is the same in both cases. What changes is the direction of the impulse that created it. Look at this 3-candle sequence on screen right now. Candle 1, candle 2, that's your aggressive middle candle. Candle 3, see the space between the wick of candle 1 and the wick of candle 3. That space is the FVG. Nothing traded inside it, price went through it without any two-sided participation. That zone is now an imbalance, and the market has a mechanical tendency to come back and fill it. Here's the cause and effect of why that return happens. The FVG formed because a large one-sided order, an institutional order, pushed price through that zone without resistance. The speed of the move means the orders on both sides never met. Unfilled orders remain inside that zone. When price returns to the FVG, it's returning because those unfilled orders are still there, waiting to be matched. The fill isn't a pattern or a coincidence. It's a mechanical rebalancing, the market completing transactions that were skipped over during the impulse. Now here's the distinction most traders miss, and it directly affects where inside the FVG you should be looking for a reaction. Price does not always fill an FVG completely. A full fill and price trading all the way through the gaps is possible, but it's not the highest probability reaction point. The 50% level of the FVG is. The midpoint of the imbalance zone represents the area of maximum unmet orders, the deepest concentration of unfilled transactions left behind during the impulse. When price returns to the FVG and reaches that 50% level, it's touching the densest part of the imbalance. That is where the reaction probability is highest. I'm highlighting the FVG right here. See that gap between candle 1 and candle 3. The full zone is marked. Now watch where price reacts when it returns. It doesn't fill the entire gap. It hits the 50% level, the midpoint of that highlighted zone, and reverses. That's not random. That is mechanical order matching at the highest concentration point of the imbalance. Now let's talk about where FVGs actually belong in your process. Because used in isolation, they're moderately useful. Combined with order blocks, they become your precision entry tool. Here's the sequence. Price returns to a valid order block, one that preceded a structural break, unmitigated, aligned with your HTF bias. That OB gives you your zone. Now, on the lower time frame, inside or just at the boundary of that OB, you look for an FVG from the original impulse that created the OB. That FVG is nested inside the institutional zone. The OB tells you where smart money's orders are concentrated. The FVG inside it tells you exactly where inside that concentration the imbalance is densest. Those two things together give you a precise entry, not an approximation. The trigger sequence works like this. Step 1, price returns to the OB zone on your entry time frame. Step 2, inside the OB on the lower time frame, you locate the FVG from the original impulse. Step 3, price reacts at the 50% level of that FVG. That reaction is your entry trigger. Step 4, your stop goes below the OB or for tighter risk, just below the low of the FVG itself. Step 5, your target is the next liquidity pool you identified back in step 2. On this chart, the OB is in the yellow box and the FVG is nested right inside it. Watch how price enters the OB zone, pushes to the FVG's 50% level, and then reverses sharply. That is the full layered entry. The OB defined the region. The FVG defined the exact point. Both tools are confirming the same thing. Not two separate signals, but one tool refining the other. Now let's talk about when an FVG is valid and when it's a trap. Because the filter is what separates this from being a random 3-candle pattern you trade every time you see it. Filter 1. The FVG must be aligned with the higher time frame structure. A bullish FVG is only a valid entry trigger if the HTF bias is also bullish. If the HTF is bearish and price is retracing, a bullish FVG on the lower time frame will often fill and then immediately continue downward. The fill was the retrace completing itself. The FVG was real, the imbalance was real, but the HTF bias meant that filling the imbalance was part of the bearish continuation, not the start of a reversal. Always run the HTF structural check before the FVG means anything. Filter 2. The FVG must come from an impulse, not a consolidation. A 3-candle sequence during sideways, choppy price action might technically show a gap between candle 1 and candle 3. But the middle candle's move wasn't driven by a large one-sided order. It was driven by noise. The imbalance is weak. The probability of a meaningful reaction when price returns to it is low. The originating move must be sharp, directional, and clearly impulsive. If you look at the 3-candle sequence and the middle candle doesn't stand out from the surrounding price action, the FVG is not valid. Look at this chart right here. 2 FVGs side by side. One from a sharp impulsive move, one from a slow ranging sequence. When price returns to each of them, only the one from the impulse produces a clean reaction. The consolidation FVG gets traded through without any meaningful response. The impulse is the filter. Filter 3, and this is the highest probability scenario in this entire video. An FVG that forms on the candle immediately following a liquidity sweep is the strongest setup available in the SMC framework. Here's the mechanical logic. The sweep engineered the move to collect orders. The FVG that forms on the sweep candle, or the immediate post-sweep candle, is the zone where price imbalanced as the institutional position was being activated. When price returns to fill that FVG, it is returning directly into the zone of institutional entry. Structure confirmed the direction. The sweep confirmed the collection. The FVG is the fingerprint of the entry itself. Freeze this frame. Liquidity sweep on the left. Price wicks below the equal lows and closes back above. The candle that closes back above creates the FVG. Price then retraces into that FVG's 50% level. That is your entry. Everything in this framework is pointing at the same point in price. The HTF bias, the OB, the sweep, and the FVG are all converging on the same zone. Now let's address the mistake that most traders make when they first learn about FVGs, because it's the same category of mistake that kills traders at every step of this framework. The wrong way to use an FVG is to trade every FVG fill you see on the chart, without structural context, without OB alignment, without checking the HTF bias. The mechanical consequence of doing that is consistent. You will be filling FVGs that sit inside larger opposing impulses. Price fills the FVG because the imbalance is real and the fill mechanism works, and then continues in the direction of the dominant flow. The fill was a temporary retrace inside a trend, not a reversal signal. Your entry was mechanically valid in isolation and mechanically irrelevant in context. An FVG is not a trade idea. It is never the reason you take a trade. The reason you take a trade comes from steps 1, 2, and 3. Structure told you the direction. Liquidity told you the destination. The OB told you the zone. The FVG's only job is to tell you where inside that zone to pull the trigger. The moment you use an FVG as a standalone signal, you've detached it from the system it belongs to. And a tool outside its system is just noise. On this chart, you can see exactly what that looks like. FVG in the middle of a bearish impulse. Price fills it. The fill is clean. And then price continues downward, 20 candles of continuation below the entry. Every mechanical element of the FVG was correct. The imbalance existed. The fill happened at 50%. The reaction was brief and real. But the trader who entered long at that FVG without checking that the daily chart was in a clean bearish structure just took a technically valid entry in the middle of a downtrend. The FVG didn't fail. The context was missing. You now have all 4 components. Structure gives you direction, liquidity gives you destination, order blocks give you the zone, fair value gaps give you the precise entry point inside that zone. Each piece is mechanical, each piece is cause and effect, and each piece is incomplete without the others. But right now, those 4 things are still 4 separate things in your head. Step 5 is where that changes. Step 5 is the full trade sequence. Start to finish in exact order, the way all 4 components merge into a single repeatable system. This is where it stops being theory and starts being something you can actually execute on a live chart. Everything up to this point has been individual components. You learned each one separately, you understand each one mechanically, and if you tested any one of them in isolation, you'd get mixed results. That's expected because none of them are standalone systems. They are parts of a sequence, and a sequence only works when you execute it in order, completely, every time. That is what this step is. What I'm going to give you right now is a 6-step decision protocol, not a checklist you glance at. A strict sequential filter where each step has to be confirmed before you move to the next one. If any step fails, you stop. You don't proceed to the next step hoping the others make up for it. The protocol is all or nothing because the edge lives in the combination, not in any individual component. Let's go through each step, then I'm going to walk through a complete read-through on a chart so you can see the entire sequence unfold from start to finish. Step A, determine the higher time frame structural bias. This is always first, always. You go to the higher time frame, daily, 4-hour, depending on what you're trading, and you determine whether price is in a clean, bullish, or bearish structure using everything from step 1. Is price printing higher highs and higher lows? Bullish bias, lower lows and lower highs, bearish bias. Has there been a recent CHoCH? Then the bias just shifted. Confirm the new structure before proceeding. If the HTF is ranging and price sitting between 2 major levels without a clear structural sequence, the answer at step A is no trade, not wait for a better entry, no trade. A ranging HTF means the structural bias is ambiguous, which means every OB and FVG you find at the lower time frame has no directional context. You'd be entering a precision tool into a situation that has no confirmed direction. Step A failing means the entire protocol stops here. I'm drawing this on screen right now. Daily chart. You can see the sequence clearly. A CHoCH printed here 2 weeks ago, followed by a lower high forming right after it. That CHoCH shifted the bias bearish. Every subsequent move on the lower time frame now has a bearish HTF context. Step A confirmed bearish bias. Step B, identify the next liquidity target in the direction of the bias. In a bearish HTF structure, the destination is sell-side liquidity, the pools of buy stops and long position stops sitting below price. You're looking for equal lows, previous day lows, a cluster of swing lows that haven't been swept. That pool is where price is mechanically drawn toward. It is the destination you identified before entering, not a target you pick after you're already in the trade. On this chart right now, you can see equal lows sitting below the current range. 2 touches of the same level, clean and visible. Below those equal lows is a dense cluster of stop-loss orders from every long position that held support at that level. That is the target. I'm drawing a line right through it, and that line stays on the chart for the entire duration of this trade. That is where price is going. Step B confirmed. Sell-side liquidity sitting below the equal lows. Step C, wait for the LTF liquidity sweep. You don't enter at this point. Price needs to engineer a move to collect lower time frame liquidity before it's ready to continue toward the HTF target. In a bearish setup, that means price will typically make a short-term push upward, appearing bullish on the lower time frame, sweeping buy-side liquidity above a recent lower high or equal high. That sweep is price collecting the fuel for the next downward leg. This is the patience phase. Price is doing something that looks wrong if you're not watching the HTF context. It's pushing up. Retail traders see that and think the bearish move is over. What's actually happening is that price is reaching for the orders above the recent high, the stops of short sellers who entered too early, collecting them and setting up the next leg down. Look at where I'm placing this marker on screen. That recent lower high right here. Above it is buy-side liquidity. Price is currently moving toward it. I'm not entering. I'm watching. The sweep hasn't happened yet. Step C is not confirmed until price pushes above that level, triggers those stops, and shows a rejection back below it. Step D, identify the order block at the origin of the sweep. The sweep was caused by something. Price didn't push upward randomly. It pushed upward from an origin point where there was a concentrated cluster of institutional buy orders engineered specifically to push price into the liquidity above. That origin point is your OB. After the sweep completes, go back to the candle that started the push, using the step 3 criteria. Last opposing candle before the impulse. Impulse strong enough to have caused a structural event, unmitigated. Identify the OB. In a bearish setup where price swept upward, you're looking for the last bullish candle before the sweep impulse began. That candle is where the institutional buy orders were placed that drove price into the liquidity above. When the sweep completes and price reverses, it will often return to that OB before continuing downward. I'm drawing this OB on screen right now. You can see it sitting just below where the sweep impulse originated. Clean, unmitigated, preceded by a sharp move upward that swept the liquidity above. Step D confirmed. Step E, wait for price to return to the OB. Do not anticipate this. Do not enter on the sweep candle itself because price looks like it's reversing. Wait for price to mechanically return to the OB zone. The reason is structural. The institutional order that caused the sweep is not fully filled at the sweep candle. Price returns to the OB because the remaining portion of that order needs to be matched. The return to the OB is the mechanism of order completion, and that completion is what causes the next impulsive move. Anticipating the OB means entering before the mechanism has occurred, cause and effect. Because the order isn't fully filled until price returns to the zone, therefore entering before the return means entering before the cause of the next move has happened. You need price back in the zone. Wait for it. Look at this chart. Price swept above the liquidity level, rejected sharply, and is now retracing. You can see it coming back down toward the OB box I've marked. It hasn't reached it yet. Step E is not confirmed until price is inside the zone. Step F, trigger entry at the FVG inside the OB. Price is now inside the OB zone. Drop to the lower time frame and locate the FVG from the sweep impulse. The imbalance left behind when price moved aggressively into the liquidity above. That FVG is nested inside or at the boundary of the OB. Wait for price to reach the 50% level of that FVG. That is your entry trigger. Stop goes below the OB or tighter, just below the low of the FVG. Target is the sell side liquidity pool you marked in step B. You should be able to see all 6 components active on this one chart section right now. HTF bearish bias. Sell side liquidity target below the equal lows. LTF sweep of buy side liquidity above the lower high. OB at the origin of the sweep. Price returning to the OB. FVG nested inside it with the 50% level marked. That is the complete sequence. Every component has a mechanical role. None of them are optional. Now let me walk this through as a single continuous read, because seeing each step named separately and seeing them flow together are two different things. On the daily chart, price printed a clear CHoCH 3 sessions ago. A bullish swing low was broken for the first time after a series of higher highs and higher lows. That CHoCH shifted the HTF bias bearish. Subsequent price action confirmed it. A lower high formed and price made a new lower low. HTF structure is bearish. Step A done. I'm scanning below current price for the next sell side liquidity pool. Right here. 2 clean equal lows sitting at a clear horizontal level, both untested. Every long position that entered at support between those 2 lows has a stop just below them. That is my target. I'm marking it and I'm not changing it. Step B done. Now I'm watching the 4-hour for a lower time frame sweep. Price has been grinding upward in a small range. And right here, it pushes above the most recent lower high, wicks through cleanly, and immediately closes back below it. That is the sweep. Buy stops above that lower high were collected. Step C done. I go back and find the origin of that upward push. The last bullish candle before the impulsive leg up is sitting right here. It's clean, it's unmitigated, and the move from it was sharp enough to take out the lower high. I'm drawing the OB box around it. Step D done. Price is now pulling back after the sweep. I'm watching it return toward the OB. It enters the top of the zone. Step E confirmed. I drop to the 15-minute and locate the FVG from the sweep impulse inside the OB. There it is. 3 candle structure, clear gap, sitting in the upper half of the OB. I mark the 50% level of the FVG. Price touches the 50% level. Entry, stop below the OB. Target the equal lows from step B. That is the complete trade. 6 steps in order, every component confirmed. I'm drawing this entire sequence on screen right now. From the daily CHoCH on the left, all the way to the target at the equal lows on the right. This is one trade, one sequence. Every step had a mechanical reason. Now let's look at the partial setup, because this is what happens when traders take 5 of the 6 steps and skip the first one. Same chart, different section. Here's a lower high on the 4-hour. Price sweeps above it, rejects, returns to a clean OB, and there's a valid FVG nested inside it. The setup looks identical to what we just walked through. OB is real, FVG is real, the 50% level is precise. But look at what I'm pointing to on screen right now, the daily chart for this section. Price is in the middle of a bullish impulse on the daily. The 4-hour CHoCH that looked bearish was an internal CHoCH within a bullish external leg. The HTF bias is bullish. Step A was never confirmed. The trader who enters short at that FVG gets the fill, because the imbalance is real and price does retrace into it, and then price continues upward, straight through the OB, straight through the stop, because the HTF institutional order flow is bullish. Every lower time frame signal was mechanically correct. The HTF context made the entire trade invalid. Cause and effect, because step A wasn't checked, therefore steps B through F were executed inside the wrong directional context. The protocol isn't a menu where you pick the steps you like, it's a filter chain. Every link matters. The patience component of this protocol is not psychological advice, it is a mechanical requirement. Each step you wait for filters out an entire category of lower probability setup. Waiting for the HTF structural confirmation eliminates every counter trend setup. Waiting for the liquidity sweep eliminates every entry that happens before price has collected its fuel. Waiting for price to return to the OB eliminates every anticipatory entry placed at arbitrary levels. Waiting for the FVG trigger inside the OB eliminates every imprecise entry placed somewhere in a wide zone. The setup that passes all 6 steps has had 4 categories of failure filtered out before you've risked a single dollar. That is your edge, not any single component, the sequence. Executing 4 out of 6 steps is not executing a slightly weaker version of the same system. It is executing a different, structurally incomplete system with a lower expected value. The protocol is the edge. The protocol runs in full, in order, every time, or it doesn't run at all. You now have a complete, repeatable trade sequence. 6 steps, fully mechanical, cause and effect at every decision point. But having the sequence doesn't mean every setup that passes it is equally valid. There are conditions under which even a fully confirmed 6-step setup carries meaningfully lower probability, and conditions under which the same setup carries meaningfully higher probability. Step 6 is the filter layer. It's the part of the system that tells you when to execute and when to stand down, even when the sequence looks perfect. Most traders who learn a system like this never add this layer, and it's the difference between a trader who runs the protocol and breaks even, and one who runs the protocol selectively and builds a genuine edge. Don't skip it. You now have a 6-step protocol that produces mechanically valid setups. The problem is that not all valid setups are equal. 2 setups can both pass every step of the sequence and produce completely different outcomes. Not because the protocol was wrong, but because the conditions surrounding the setup were different. The filters in this step don't replace the protocol. They sit on top of it. They are the conditions that tell you whether a fully confirmed setup is worth executing or whether it should be passed. There are 4 filters. Each one has a mechanical cause and effect basis. None of them are opinions. Filter 1, session timing. The SMC trade sequence works most reliably during 2 specific windows: the London Open, which runs roughly from 2 a.m. to 5 a.m. EST, and the New York Open, which runs from 7 a.m. to 10 a.m. EST. These are not arbitrary time blocks. They are the periods when institutional order flow is at its highest concentration. And because the entire SMC framework is built around institutional behavior, sweeps, OB reactions, displacement, it follows mechanically that the framework performs best when institutions are actively participating. Cause and effect. Because institutional order flow concentrates during London and New York Opens, the liquidity sweeps during those windows are more decisive, the OB reactions are more impulsive, and the follow-through after entry is more sustained. The orders are large enough to actually move price through your target. The trap version of this is taking the same setup, Fully confirmed, all 6 protocol steps checked during the Asian session or midday consolidation. The sweep still happens. The OB is still valid. The FVG entry still triggers. But the follow through is weak because there isn't sufficient active order flow to sustain the move. Price drifts, chops, reverses halfway to the target and stops you out. The setup was structurally correct and contextually wrong. On screen, I'm showing you the same OB reaction at 2 different times. Left side, London Open. The candle reaction at the OB is sharp, impulsive, closes near its high. Right side, Asian session. The reaction is slow, produces 2 or 3 indecisive candles, and reverses back through the OB. Same structure. Different order flow context. Timing is not a preference, it's a mechanical variable. Filter 2, premium and discount zones. Every price range, whether it's a full HTF swing, an impulse leg, or the range between 2 structural points, has a 50% level. That midpoint is called equilibrium. Above it is the premium zone. Below it is the discount zone. The mechanical rule is this: in a bullish structure, you only take buy setups that appear in the discount zone, below the 50% level of the current range. In a bearish structure, you only take short setups in the premium zone, above the 50%. The reason is mathematical. If you enter a long in the discount zone, the distance from your entry to the top of the range is greater than half the range. If you enter a long in the premium zone, you're entering in the upper half. The majority of the range is already behind you. Your target is closer, your stop is the same size, and your risk to reward is structurally compressed. Cause and effect. Because entering in the discount zone means the target is in the larger half of the range. The risk to reward ratio is mechanically superior, not because it looks better visually, but because the math forces it. On screen, I'm showing you the equilibrium line drawn right at the 50% level of this bullish swing. The OB is sitting in the lower third of the range, deep in the discount zone. That setup has the full remaining range as its potential target. Compare it to an OB sitting just below the top of the range. Same structure, same protocol confirmation, but the entry is in premium. The target distance is a fraction of the stop distance. The RR is inverted. Don't take it. Filter 3, displacement after the sweep. After a liquidity sweep, the reversal move needs to show displacement. Displacement is a specific type of price movement, a strong one-directional candle or tight sequence of candles with minimal wicks, closing near the extreme of the candle, near the high for a bullish reversal, near the low for a bearish one. What displacement tells you mechanically is that a large institutional order was placed at that sweep point. The candle is moving fast in one direction with no hesitation because the order behind it is large. Without displacement, the sweep may have been caused by retail stop running, a smaller participant or algorithm pushing price briefly through a level to collect stops without the institutional accumulation needed to sustain a reversal. The sweep looks the same on the chart. The difference is in the reversal candle. Look at the size and close of this displacement candle. Compare it to the weak candles from the earlier section. The displacement candle closes within a few ticks of its high. Its body is large relative to its wicks. The candles around it are smaller. That candle is the fingerprint of institutional entry at scale. A sweep followed by a small-bodied wicky reversal candle is not displacement, it is hesitation, and hesitation at a sweep point means the institutional order either wasn't there or wasn't large enough to drive the move you're counting on. Filter 4, multi-timeframe confluence at the order block. A valid LTF order block sitting inside a confirmed HTF order block, HTF fair value gap, or HTF structural swing point is a categorically stronger setup than an LTF order block sitting in open space with no HTF reference. The mechanical logic is additive. If the 4-hour chart has a significant OB or FVG at the same price zone as your 15-minute entry OB, then both timeframes have concentrated institutional orders at that level. The total order volume at that zone is higher. More orders at a zone means a more forceful reaction when price reaches it. More fuel for the reversal. More follow-through toward your target. Practical rule: an LTF OB inside an HTF OB rates higher than an LTF OB in open space. An LTF OB at an HTF structural swing point rates higher than one between structural levels. Whenever you have multi-timeframe orders stacked at the same coordinate, that is where price reactions are most impulsive. I'm highlighting the multi-timeframe confluence zone here. You can see the 4-hour OB in the larger yellow box, and nested inside it on the 15-minute is the LTF OB we're using for entry. Both time frames, same price zone. That is not coincidence. That is the convergence of two separate institutional reference points at the same level. When price enters that zone, it's entering two zones simultaneously. The setup scoring framework. Take everything you just learned and apply it as a simple binary score. For every setup the protocol produces, you score it on 6 criteria, 1 point each. HTF bias confirmed, 1 point. Entry and discount or premium zone, 1 point. Liquidity sweep confirmed, 1 point. Displacement candle present after the sweep, 1 point. Session timing, London or New York open, 1 point. Multi-time frame confluence at the OB, 1 point. Maximum score, 6. Minimum threshold for execution, 4. Below 4 points, you do not take the trade. The mechanical reason is precise. Every missing criterion represents an unverified assumption about institutional intent. A score of 3 means 3 things about this setup are mechanically unconfirmed. You are not taking a slightly weaker trade. You are taking a trade where 3 of the 6 conditions that define your edge are absent. That is not the same system. Assumptions do not have edge. Confirmed criteria do. A score of 6 means every condition that supports institutional participation in your direction is present and verified. A score of 4 means the majority are confirmed with 1 or 2 conditions missing. Still executable, still within the bounds of the system. Below 4, stand down. On this chart right now, let's score it together. HTF bearish bias, confirmed, 1 point. Entry and premium zone, confirmed, 1 point. Liquidity sweep, confirmed, 1 point. Displacement after the sweep, present, 1 point. Session timing, London open, 1 point. Multi-TF confluence, LTFOB inside an HTF FVG, 1 point. Score, 6 out of 6. That is the setup you wait for. That is the setup you execute without hesitation. Now compare it to this one on the right. HTF bias, confirmed. Premium discount, confirmed. Sweep, confirmed. Displacement, weak candle, no displacement, 0. Session timing, Asian session, 0. Multi-TF confluence, LTFOB in open space, 0. Score, 3 out of 6. Protocol says no trade, not because it looks bad, because 3 unverified assumptions about institutional intent are baked into it. Pass it. Conclusion, the complete system. Let's run the full chain one time, clean, start to finish. Higher time frame structure gives you the direction, bullish or bearish bias, confirmed by the mechanical sequence of highs and lows with a BOS or CHoCH defining the most recent structural shift. Liquidity tells you the destination, the specific price coordinates where stop clusters are resting, where price is mechanically drawn before it can continue. The sweep fuels the move. Price engineers a short-term push into that liquidity pool, collects the orders, and creates the condition for the reversal. The order block gives you the zone, the last opposing candle before the sweep impulse, where institutional orders were placed and where remaining orders are still waiting. The fair value gap gives you the entry, the imbalance nested inside the OB with the 50% level as your precise trigger point. And the filters confirm it's worth taking. Session timing, discount or premium zone, displacement, multi-time frame confluence, all scored before a single dollar is risked. That is the complete system. 6 components, 1 direction of causality, no steps that can be reordered or skipped. Look at this final summary chart on screen. All 6 components marked on one setup. HTF structural bias on the left, liquidity target identified, sweep confirmed, OB boxed, FVG nested inside it with the 50% level marked, filter score visible in the corner. This is not 6 tools applied to a chart. This is one sequence unfolding across time, each step producing the condition that makes the next step possible. Now here's what this video actually did, stated mechanically, not as a compliment to itself. The problem at the start was specific. SMC gets taught as a collection of disconnected concepts, which means traders learn what each thing looks like without learning when each thing is relevant. The result is paralysis. A chart covered in labels with no operational sequence connecting them. What this video did to solve that was equally specific. It presented each concept in the order it operates. Structure before liquidity, because structure defines the direction liquidity is relevant to. Liquidity before order blocks, because the sweep is what makes the OB actionable. Order blocks before fair value gaps, because the OB defines the zone the FVG needs to sit inside. The sequence was the fix, not more concepts, just the correct order of the concepts you already had. Now here is your next step, and it is not optional if you actually want this to work. Open your charting platform right now. Pick 3 instruments. On each one, mark the HTF structure, identify the most recent CHoCH or BOS, and determine the current directional bias. Then identify the nearest liquidity pool in the direction of that bias. Then look left and find any recent sweeps. For each sweep, find the OB that preceded it. Do that exercise on 3 charts before you watch anything else. Cause and effect. This system builds pattern recognition through active marking, not passive watching. Every minute you spend watching without a chart open in front of you is not practice. It's content consumption. The two are not the same thing, and your results will reflect which one you're actually doing. If you want to continue from here, the next video covers position sizing using this system and trade management once you're inside the move. Because entering at the right level with the wrong position size or exiting at the wrong point after a correct entry produces the same result as a bad trade. That video is already on this channel. If this level of mechanical detail is what you want from your trading education, subscribe. That's what this channel is.